The debt spiral nobody saw coming. It began as a whisper, quiet, distant, almost dismissible. But that whisper soon grew into a pressure that wrapped itself around an entire economy, tightening day by day until escape became impossible. This story matters now because debt defines a rhythm of modern life. Nations borrow, corporations borrow, ordinary people borrow, but none of them believe the spiral will ever turn on them. To see how quickly confidence can collapse, we need to go back to the moment when one country convinced itself that debt was not a danger, but a tool that could be stretched forever. It started with optimism. Growth was strong. Investments flowed. The government believed it could fund progress by simply pushing repayment further into the future. Each new loan felt harmless, a bridge to better times, a temporary lift that would surely be paid back once prosperity expanded. And at first, it worked. Projects rose across the landscape. Markets cheered. Investors nodded with approval. But beneath that confidence, the numbers were beginning to swell. Interest payments crept higher. Budgets tightened. The country relied more on short-term financing, borrowing to cover the borrowing that came before. It was manageable at first, but only because the world around them stayed calm. Then came the first shift. Foreign investors began questioning whether returns matched the risk. A quiet migration of capital followed, subtle but steady. Tensions grew inside the central bank. Advisors warned that their debt trajectory was drifting toward dangerous territory. But policymakers brushed aside concerns. After all, nothing dramatic had happened yet. Soon, every new bond auction carried a hint of unease. Yields ticked upward. Buyers became selective. Rumors spread through financial circles about hidden weaknesses in government accounts. The early reveal was clear. The spiral had already started, long before anyone recognized it. And with each passing month, the weight of that unnoticed spiral pulled a little tighter. The pressure deepened as lenders grew cautious. They still showed up, but their terms sharpened. Higher yields, shorter maturities, stricter conditions. What once felt like a friendly partnership now felt like a negotiation at the edge of a cliff. The nation didn't panic. It adjusted. It rolled over old debts, issued new ones, and assured the public that everything was normal. But the data told a different story. Debt service costs were accelerating faster than revenue. A larger share of the national budget was now devoted to merely keeping the machine alive. Schools, hospitals, and infrastructure projects saw their funding quietly trimmed. Officials tried to mask the cuts behind optimistic forecasts, but those forecasts depended on growth that never arrived. The reveal continued when a ratings agency issued a subtle downgrade, not catastrophic, but symbolic, the kind that sends a ripple through global bond desks. Within days, capital outflows intensified. Funds rebalanced their portfolios, trimming exposure to the country's bonds. Traders began whispering about a possible liquidity crunch. The government insisted concerns were exaggerated. Yet every denial only made the markets more uneasy. Then came the early conflict. A major debt auction failed to attract enough buyers. For the first time, the government had to intervene directly, purchasing its own debt to prevent a public embarrassment. Inside the finance ministry, a quiet panic took hold. Officials debated emergency measures. Some argued for austerity. Others pushed for stimulus. But both options came with risks. Austerity could crash the economy. Stimulus could worsen the debt spiral. Meanwhile, the central bank wrestled with its own dilemma. Raising interest rates could strengthen the currency, but would also increase borrowing costs. Cutting rates might ease the burden, but risk capital flight. Each potential move carried consequences that spread far beyond the country's borders. The world was watching now. Investors analyzed every headline, every speech, every leaked memo. The sense of stability that had propped up the country for decades was dissolving. And still, the spiral tightened, not through any single dramatic event, but through a steady erosion of confidence. This was the moment the nation realized its problem wasn't just financial. It was existential. It wasn't simply about paying bills. It was about trust from investors, trust from citizens, trust in its own economic future. And that trust was slipping away, inch by inch. The breaking point arrived with a shock that spread faster than the officials could react. A foreign hedge fund publicly announced it was betting against the country's bonds. It wasn't the size of the bet that mattered. It was a signal. Within hours, traders across the world followed, shorting the nation's debt as if sensing blood in the water. Yield shot upward. Borrowing costs spiked. Overnight, the budget calculations that once looked tight now looked impossible. Panic rippled through the government. Emergency meetings piled into one another. Advisors drafted statements meant to restore calm, but each attempt only exposed deeper cracks. The prime minister demanded reassurance from the central bank, yet even the governor struggled to promise stability. Behind closed doors, they all understood the danger. If borrowing costs stayed elevated, the nation would be unable to refinance its upcoming maturities. The conflict intensified when a major domestic bank revealed its heavy exposure to government bonds. Its balance sheet trembled under the strain. If the bonds fell further, the bank itself could collapse, and with it, the confidence of millions of citizens. The central bank prepared contingency plans, while markets speculated whether a bailout was imminent. Then came the global contagion effect. Neighboring countries saw their own bond yields rise in sympathy, as investors feared the crisis might spread. Currencies slid. Stock markets convulsed. International organizations issued cautious warnings. Suddenly, what began as a single country's debt spiral had become a regional threat. Inside the country, fear grew on the streets. People withdrew savings. Businesses delayed investments. Politicians argued on live television, accusing one another of causing the crisis. The media amplified the chaos. What had once been abstract figures in financial reports now became a daily anxiety for millions. As the situation deteriorated, the nation faced a brutal dilemma: accept a rescue package from international lenders, one that demanded severe austerity and loss of economic control, or attempt to fight the crisis alone, risking a catastrophic default. Both choices carried pain. Both threatened to reshape the nation's future. This was the peak of the conflict, where every path forward led through uncertainty. The debt spiral that had once been invisible now consumed every conversation, every headline, every calculation. The country stood on the edge of a precipice, with the world watching to see which way it would fall. And in that suspended moment, the tension reached its highest point before the consequences would collide with reality. The final blow came not with a dramatic collapse, but with a quiet admission behind closed doors. After weeks of turmoil, the government accepted the rescue package. The conditions were harsh: deep spending cuts, tax increases, oversight from foreign institutions. It was a loss of autonomy that stung the nation's pride, but the alternative was a default that could have shattered the economy for a generation. As the agreement was announced, markets steadied for the first time in months. Yields eased. The currency found its footing. But the relief was thin. It rested not on strength, but on surrender. Citizens watched as the government detailed the measures ahead. Reduced pensions, higher prices, fewer public services. The spiral had reached its climax, and now its consequences settled over the nation like a heavy fog. For many, it felt like the ground had shifted beneath their feet. Families wondered how they would manage rising costs. Small businesses calculated whether they could survive the downturn. Even the wealthiest investors reassessed their exposure, realizing how quickly stability could corrode. The story of the crisis was no longer about numbers. It was about people, millions of them, carrying the weight of decisions made years earlier. Yet in the midst of the hardship, a clearer understanding emerged. Debt isn't a quiet companion. It's a force that grows, stretches, strains, and eventually demands repayment in ways that reshape entire societies. A nation can ignore the warning for only so long before the pressure becomes unavoidable. And when it does, the reckoning is rarely gentle. But the resolution also carried a lesson for the modern world. The spiral doesn't begin with panic. It begins with comfort. It grows in silence. And by the time it becomes visible, it has already woven itself through every layer of an economy. Recognizing the early signs, rising yields, shrinking confidence, swelling obligations, can mean the difference between control and collapse. As the country rebuilt, slowly and painfully, it learned that stability isn't guaranteed by optimism or policy alone. It comes from respecting the power of debt, the way it can lift or crush, sustain, or smother. Sometimes the smallest shift in perspective becomes the beginning of a new future.